So, a couple of things that reflect on what you have seen or heard if you watch the video. Some of the general things that a grade 12 applied student needs to answer when it comes to terms, okay? Why would a person tolerate risk? Like, why would you accept risk in your investment? Is there any brave volunteer that would want to say anything about that? Why would you be okay with risk, with risking money when you invest? What would be your pull to even consider that? Yeah. You earn more. Yeah. The more you're willing to risk, the more potential gain. Yeah. So I'll write something like this, okay? A higher risk is usually, can you see that all right? Associated with higher gains or returns. Another way of saying there's a potential for higher returns. Have you heard of that saying, high risk, high reward? It's basically, it comes from finance as well, or it's, right? High risk, high reward. But can you say it's 100% of the time true? No. So potential, okay, the key word is potential higher returns. What's the benefit? To market-based investments as opposed to fixed rate investments, such as GIC and bonds. Market, when you go by market, I want you to think of stocks. The stock market, right? That's what market-based investments are. So you're literally buying shares, right? So I will say stocks, shares, you're buying ownership in a company, right? You're buying into a company. So, and so your gain is really by those shares that you purchase gain and value. And when you sell them, you make that difference, right? Anybody know what a GIC is? Because that's going to come up quite a bit. Do you remember hearing about a GIC? Guaranteed Investment Certificate. Okay? Certificate. In Canada, we no longer have bonds.
Excuse the interruption. Unity Goodmanson, please go to senior gym. Unity Goodmanson to senior gym, please. Thank you.
Bonds, folks, if you ever, because it's still happening in the world, it's basically when you lend to the government. So the government needs a lot of money to run their operations. So sometimes they need millions, billions of dollars to do a project. So if you buy a bond, so they'll be like, hey, we're selling bonds. So you're basically giving them your money. They'll use it to do their project, and then they'll repay you with some interest. So it's cheaper for them to borrow from you than to go to another nation and borrow from them, right? Because they don't have to promise you higher interest rates. It's just like average interest rates, and you'll be happy with it because it's quite safe. Because a sovereign nation can't declare bankruptcy. Like a country can't just be like, oh, we're bankrupt, we can't pay you back anymore. So it's safer in that regard. So what is the benefit of market right, or shares versus a GIC as opposed to a GIC. This one is very safe, very safe. If you ever hear the word GIC in this document, in this unit, you're thinking, oh, a GIC is super safe. It's guaranteed. So this one is higher risk. Higher risk. I'm not saying it's within your stocks. There's really high risk, very, very high risk stocks that you can buy, like crypto. Crypto, yes, it's the hype, but it's also like it could crash any moment, right? Crypto has gone up like crazy and then boom, it just fell. And now it's on its way up again, right? So that would be a very high risk versus just buying stocks and like at a company like Apple. It's probably pretty safe, right? If you buy into Apple or Samsung or one of these tech companies that have been around for a long time, it's still higher risk because it can drop any moment, but so the risk level is kind of like depending on your decision making. But that's in general, we would say a market base is higher risk and a guaranteed investment certificate is safe, okay, low risk. I'll write low risk next to it. I know it's a little messy. I'm a little all over the place here, but I kind of want you to just have a bit of a general idea of where we're going. Why would you go with this? What's the benefit of market base as opposed to the fixed rate? Fixed rate, so the name says it all. No matter how good the market does, a fixed rate investment will stay whatever they promised you. So let's say a guaranteed income certificate, a GIC, promises you 3%. Even if the global market goes up like crazy, they're like, no, we promised you 3, that's it, right? So a lot of people like it because they're guaranteed to get something back. And some other people are like, well, what if I miss out on the potential gain that I could have had under this investment model, right? So the higher risk. So again, this goes back to the previous one. It's really due to the potential higher returns. So although it's high risk, people would still go with stocks, right, due to the potential higher returns. Another bullet you could use is your funds are not locked in. Under a guaranteed investment certificate, you are locked in. You could sign a 1, 2, 3, 4, all the way to 5-year agreement, and then you have to leave your money in there. So that's a downside, right? You can't just take your money out whenever you want. Here, you could just sell your stocks or your shares, and then you have your money back, right? So I'm going to put next to guaranteed, it's you're locked in. Your funds are locked. You're going to have to find ways to add this to your study sheet at some point, okay? So basically, this little thing summarizes, like, why would somebody want to go with a GIC? You could say it's much safer. It's a lower risk investment, right? So that's your main reason why you might want to go with it. What's the downside of a GIC? Your funds are locked in, right? You can't just take them out whenever you want to use it. Let's say you want to buy a car. You sign 5 years, and in 2 years, you're like, I need a car. You can't access that. You have to go borrow money. And then once the 5 years are over, then you get your money back from this investment, right? So pros and cons. What are the advantages of diversifying your investment portfolio? This is a very loaded question, okay? Diversifying is the key, is a very important term where you kind of spread out. You spread out your money. That is basically what diversifying is. Like, you don't just put all your eggs in one basket. I don't know if you know that saying, right? Don't put all your eggs in one basket. What is a portfolio, right? It is all the investments you hold. Portfolio is like considered like it's almost like a folder. Consider it a folder. It's like these are all my investments in that folder. Okay, that's what a portfolio is. So what are the advantages of diversifying a portfolio? It will say a couple of things you can say is that, let's do an example here. Let's say that your portfolio consists of, you have a GIC account, you have some shares, and you have some gold, bullion they call it, right? Gold or precious metals. That right there is diversifying. You don't just say, hey, what's your portfolio? I've got all my money in GICs, Mr. Rickson, that's all I have. It's like, you shouldn't just have everything in one. Let's add another one here. I don't know if you heard of a TFSA. I'm going to talk about the TFSA. I talked about it on the video, I'm sure. It's a tax-free savings account. They started this not too long ago. And so you should take advantage of that. Once you turn 18, you can open a TFSA. And I'll give you the information of a financial advisor that I have used in the past. And he says it's okay to pass around his info. So I'll give you his card. If you want to start like investing, he's the guy to, he's probably close to retirement. So you might want to get on it once I give you that info. And I know him personally, but he does meetings over Zoom to set up your paperwork and all that. Like, you don't even have to drive down to where his office is. So that's pretty cool. Anyways, this is a diversified portfolio right here. You could have crypto, you could have more, right? Some portfolios are way more diverse. Sorry, guys. Way more diverse than others. So why would you want to do this? Well, why would you want to go low risk? Well, if the whole global market goes down the drain in terms of the economy, if there's a meltdown in the global economy, your GIC is going to kind of save you, right? It's not going to go anywhere because it's guaranteed. On the other hand, what if the global market does very well? Then you have some in the safe zone, and your shares are going to like go up. So your entire portfolio is going to kind of go up even faster than just having all your money into the GICs. So it's kind of like to offset losses and also to promote growth if the global economy is doing well. So that's why you want to have, gold is very safe as well, by the way. Gold is one of the safest investments you can, one coin right now, a gold coin, I think is it an eighth of an ounce? Is like $600. I have to look it up. I'll check that. But gold is very expensive right now. So why would you want to, what's the advantage? What are the advantages of diversifying your portfolio? It is to offset losses of one investment. To offset the loss. So if you lose on one, you still have the other ones that are going to kind of carry you through. Okay. Another one is you don't lose all your money in the event of a recession. allows for higher gains if high risk investments do well. So you want to take advantage of that, right? If the global economy is doing well, you want to take advantage of that. You don't want to just be like, I like zero risk, I'm going to put all my money into GICs. And I would say this is also a long game. This is not a short game. You don't just invest like this so that in 3 years you take all of it out, okay? You want it to stay there for a long time, hopefully looking at retirement, right? So even if the stock market goes down, right, it will go back up at some point. That's usually the trend. And did you know that the ups and downs of the stock market is what actually makes you money? Quite often, if you buy stocks when they're low, and then you sell when they're high, that is where you make your money, right? And so you sell when it's high, you buy when it's low, and then you wait for another dip like that, and that's when you take advantage of it, right? So it's actually not always a bad thing for certain stocks to go down, okay? Next, how should an investment portfolio change as one ages? Like, how should the amount of money that you have in each one of these funds, how should that change as you age? So what, in general, the risk factor should decrease as you age. So if you're young, if you think of a line here, and this is low risk, and this is high risk, okay? You can have most of your money, if you want, like most of your money in the high risk area, and then some, and very little in the low risk, okay? When you're older, this is low, this is high. When you're older, you should actually do the exact opposite. You should start switching your money, most of it, into low risk investments and very little in high risk investments. Why would that be? When you're older, you don't have the time to gain back what you've lost, right? Like, let's say the market crashes and you're like 67, 70, you're not working anymore. If the market crashes, you don't have that luxury of like, oh, time is going to gain it back, right? You don't have that anymore. And so that's why we want to do that. So you want to kind of go exactly the opposite as you get older. Is this going to be the case for everyone? No. There's people that are like, no, I'm older, I'm fine. I want higher risk. Like, I'm a gambler, right? It's a bit of a gamble. But this is what we would suggest in this course, and most advisors would do the same, okay? All right. Give examples of different kinds of investment portfolio a person might own. I think I just did that, but I can do an example here. Example 1, let's say you have a TFSA. That's basically a savings account. Okay? You might have stock, and you might have a GIC. That might be one person. Just 3 things, right? Nothing too complicated. Example 2, you can have an RRSP. That's a registered retirement savings plan. And I talk about that in the video too, the intro video. So if you have a chance, I can't do all of it in one class, right? But that's every time you have an R at the front, it's a registered. So that's like a government sanctioned investment. It's usually very safe, okay? You might have RESPs. What are RESPs? Registered Education Savings Plan. Maybe some of your parents, if you talk to them about it, they've told you you've got some money set aside for post-secondary. I don't know if some of you have told you about it. It's probably sitting in an RESP, a Registered Education Savings Plan. So once you graduate and you show proof that you go to post-secondary, money can be withdrawn to fund your education. You can have some crypto. You could have some precious metals. You could have a GIC. Let's make it really complicated, right? So portfolios just mean like there's a folder and there may be various investments in that folder. Okay? So keep that in mind. All right. If you go to page 8. I have, if you look at the along the x-axis, you've got risk. Okay, there's risk here, and we compare the risk to interest or how much you're getting back. Okay, so it goes from high to low, and risk also high to low. So I kind of have a bit of a guide here for you. Just in the white in that booklet there, you won't need as well. So cash, for example, is relatively low risk, but you're also not really going to get back. Did you know that your purchasing power, like if you put it under your mattress, or you have like a piggy bank, if you put your money in there, every year that money is worth a little less. So if you have 100 inflation, just leave it there for now. Inflation, have you heard of inflation? Inflation is basically how much purchasing power you lose every year. On average in Canada, it's 2%. So what does that mean? If you have $100 under your mattress, right? $100, you put it in today, a year from now, that $100 bill is technically only going to be worth $98. Like in terms of what you can buy with it, 2% loss. What's going on? And so every year you lose 2%, 2%, 2%. So you want to invest it to make sure you at least keep up with inflation. So interest rate, if you get a 2% interest rate on your savings, at least you're keeping up with inflation. Like you're losing 2% purchasing power, but that interest rate that the bank is giving you, the 2%, is like keeping up with that loss. So you're at least staying even. You want to probably find an investment that gives you like 5, 6, 7, or 8%, which is not a stretch. It's very doable. Okay? And I think I want you to start saving at an early age. We will do this in class, okay? But I'm just going to show you real quick. Did I do these what ifs last year? I'm not sure. We have a finance app. Right now you don't have to follow, but let's say you open a savings account when you're 20. And you're going to retire at 67. How many years is that from 20 to 67? 47 years. And you're going to do this every month. So I'm going to go 47 times 12. Let's say you get an interest rate of 6%, let's say. You have nothing to start off with, but you're going to be putting in $300 a month into that savings account. As soon as you start making money, you do this, okay? I'm going to put this at 12 and that at 12. Notice the future value. FV is future value. How much money will you have after 47 years of putting $300 in every month? Let's see. I don't know if you can see that, but that's almost $1 million by the time you retire. Now you might say, well, $1 million won't be a whole lot back, like that far ahead. I'm like, right? $1 million is still $1 million, right? Like it's still a lot. It's going to be a lot, so it's going to get you by. And that's provided you keep it at $300 a month. And that's also provided you only get 6% interest. But if you find one, I found one that gives me about 8. So if you change that 6% to 8%, let's look at what our future value is going to be. I'm going to solve that. Look at that. You're going to have $1.8 million if you get an 8% interest rate as opposed to a 6% interest rate. I like to play around with this sometimes. So what if you change your $300 a month? What if you do $500 a month? Ready for this? You would have $3 million if you do $500 a month at 8% or 47. This is 47 years. Okay, you'll have $3 million in the bank. And you might say $500 a month. That's a lot. It is. I'm not denying that. But what I'm trying to tell you is, time is on your side. Time is what makes this money grow. Okay, because I'm going to do this on the side here so you can see. If you make 564 contributions, right, of $500, you put in from your own money $282,000 over 47 years. And that grew to $3 million. So just imagine you're saying, hey, give me $282,000 and I will turn it into $3 million. That's what time and interest does to your investment. It grows. It just grows on its own. It's like a snowball effect. Okay, and so the earlier you do this, the better off you're going to be. And I just want to encourage you to do that. Okay, time is your friend. Anyway, so cash, low risk, but there's also very low return. GIC, it's also low risk, also low on the return side, right? Like as the risk goes up, so does the return. So TFSA, government bonds, real estate. Real estate is like buying a house. It's somewhat high risk, but it also gives you a lot of money if the market continues to grow the way it is. It's doing pretty good. And then the highest risk would usually be stocks or shares in the market. So highest risk, highest reward, but also potential of loss, right? Potential higher losses for a share. So that's a downside of it. Anyways, I'm going to stop here. Now